we talk about the Reserve Bank of India's guidance on interest rates and the direction interest rates are taking, we often celebrate the fact that interest rates are going down. It's expected to be a good thing because that means loans will be cheaper, this will encourage business, etc. But we often forget about a very core constituency who gets impacted adversely with falling interest rates, and those are the depositors. Especially now, depositors are having a tough time with interest rates at lows, at massive lows for your fixed deposits. And remember, the fixed deposit is an Indian household favorite. Nearly 50% of all savers put their money in some deposit or the other, and a lowering of interest rates impacts very vulnerable classes like senior citizens as well. Today on the show, we're going to talk about whether this is a long-term structural issue, whether it's time to get over this love for the fixed deposit, and if so, what are the options. But first, let's take a look at why interest rates have been falling.
Remember the heydays of double-digit returns on fixed deposits? Well, those days are behind us, and a return to that golden era for depositors is actually unlikely. Banks have been slashing interest rates on fixed deposits repeatedly. India's largest bank, the State Bank of India, has made 2 rate cut announcements in just May this year. On 12th May, the SBI lowered interest rates by 20 basis points for FDs up to 3 years. This was followed by a 40 basis point cut across tenors on 27th May 2020. So what determines and impacts the level of fixed deposit interest rates? The monetary policy adopted by the Reserve Bank of India, the liquidity situation of banks, the rate of inflation and demand for loans. All of these influence a bank's decision to cut or hike fixed deposit interest rates. Although the major factor causing a steady cut in interest rates currently is the ample liquidity in the banking system. And here's the other deciding factor for fixed deposit interest rates: the credit offtake for banks, which has seen a slowdown because of COVID-19. According to the latest data from the RBI, credit growth for scheduled commercial banks moderated to 6.4% between April and June 2020 from 11.7% a year ago, while aggregate deposits growth accelerated to 11.5% in the quarter compared to 10.1% last year. The credit to deposit ratio, which is a measure of how much the bank lends from the deposits it has received, has also seen a decline. From 76% in quarter 4 of FY20, the credit to deposit ratio has declined to 73.1% in the first quarter of FY21.
To put it simply, banks are earning less from lending while deposits are piling up as customers rush to park their funds amidst this uncertainty. Lower interest rates received from loans disbursed, coupled with adequate liquidity, leaves no incentive for banks to lure customers or offer them higher interest rates on fixed deposits. Banks too are parking their funds at a reverse repo rate of just 3.35%, which is the lowest in a decade. Since the banks are earning lower interest on their funds, the interest outgo too will be lower.
Manish Dangi of Aditya Birla Sun Life AMC calls this a theme of financial repression for Indian depositors.
The depositors are deploying their money for 1 year, 2 year at 5% or thereabouts. And it's very likely that the banks would actually bring down these 1 year, 2 year fixed deposit rates for next 1, 2, 3 years. So I think the broad theme that there is a financial repression, that there is very little that you earn in fixed income, real returns I mean, which is why you must go to equities.
While the focus is usually on loan rates that need to be low to boost a sagging economy, the crisis for the Indian saver is clearly a growing one. With Priyanka Iyer, Vikram Oza in Mumbai for ET Now.
All right, joining me now to speak about, the trend of fixed deposits falling and whether this is something that will continue for some time now. I'm joined today by Dhirendra Kumar, CEO of Value Research. Lakshmi Iyer joins me on the show. She is CIO of Fixed Income and Head Products, Kotak Mutual Fund. And Saugata Bhattacharya, Chief Economist of Axis Bank, also joins us on the show. Welcome to all of you and thank you so much for speaking with us today. Lakshmi Iyer, let me begin by getting your take. Do you think that we are seeing a structural shift in the direction of fixed deposits and the interest rates they offer? considering that we are now in the middle of a pandemic, we're going to take some time for recovery, and liquidity is no issue at all. Banks have no real reason to increase fixed deposit rates right now.
So, hi Tamanna, good evening. What I was saying is that the interest rate follows a particular cyclical pattern, and the cycle, how long or the longevity of the cycle is a function of how intense is that particular event or a crisis. In this particular case, it is a medical emergency to which the financial world is reacting, whether it's in India or the rest of the world. So it looks like it's going to be slightly more long drawn, because we are in a phase which is characterized by significant liquidity, which is chasing far too few assets, which means all of us together are pumping in more money into the banking system, and the banks are not on lending at the same pace at which they are accruing deposits. So therefore, looks like this is going to be slightly more prolonged, as much as we see liquidity in the banking system, which is not likely to abate anytime soon.
So in this case, Saugata, what do you think is the option for depositors? And in the larger scheme of things, looking specifically at the way India saves and the average Indian household puts its trust in deposits, do you think that the plight of depositors is completely, sidelined in the big picture?
No, so you're completely right. And I completely agree with Lakshmi that this is likely to be a slightly more longer drawn because of the liquidity, and the RBI is very seized of this fact that the latest round of the Operation Twist, etc. And knowing that the liquidity, the inherent drivers of liquidity, the forex flows that are coming in from outside. The amount of money that the Reserve Bank of India will have to spend with the fiscal program, that liquidity is not going to go down anytime very soon. So together with that, and most critically, the fact that there is very little demand for credit, either demand or risk aversion from banks, that there is this surplus liquidity that is likely to persist in the system. Given this, what are the options? And this is very, very critical for a very large segment of depositors. The senior citizens are a fairly significant part of total deposits that come in, fixed deposits that come in. So one option, of course, is the small savings deposits. So that obviously, that's an indirect way of getting into the money into the banking sector, because the small savings deposits actually come back into the banking system once the government spends that money. So that's a significant amount. But I think given the proclivity, I'm not saying the other options are much better. When bonds, retail bonds have not taken off too much. So that's an option. So, the options really, and Dhiren is sitting here, obviously from the equity side, but from a senior citizen's perspective, equities are a somewhat more limited option. Obviously, this option exists for young people, and young people should get into equities in a prudent fashion, but they should get into equities. But otherwise, I think bank deposits are still the best option, and which is exactly what you're seeing in the growth of bank deposits.
That's the other strange thing. Bank deposits are growing at a healthy rate. Loans are not. Banks have no real push or need to increase deposit rates. In fact, it may be better for their health if deposit rates are dropped even lower. But Dhirendra Kumar, what does that do for investors? The markets have caught everyone's fancy right now. There's a whole new crop of investors that have come in, but it also comes with a lot of volatility. What would you suggest as options, and what can people who have that inherent unshakable faith in fixed deposits do?
They are doomed, because I don't see any change in the outlook. Interest rates are unlikely to go up in a hurry. Not only that, in fact, there will be a flight to safety to bigger banks, safer banks, and relatively well-known banks, simply because recent experiences of depositors is quite scary. More so given their age, the senior citizens, even if they get 0.5%, 1%, but for some marginally higher return, nobody is really going to put his capital at stake. Not only that, India has been a historically fixed depositors country. Equity penetration is very low. Nobody has been used to, nobody has really decoded the equity story, even if it is an impressive story in academically or theoretically or, number wise, or if we plot the chart, the long-term story. But nobody has experienced it simply because, investors have been very seasonal. Good times they come and bad times they get bailout, cursing the market, never to come back again. So for these people, for senior citizen, I think it is going to be, very perilous. They don't have much of an option. All they can do is, optimize their return. But even where they actually move their money to optimize their return, something like senior citizen savings scheme or Government of India bond, which will be marginally higher than a deposit rate, it'll come with reasonable safety. But it is not going to alter their complexion. It is not going to really comfort them. Not only that, they will also come down very much in line with, the declining interest rate. And I don't see this complexion changing simply because, the destruction of demand, it is unlikely to, drive inflation. And I also see that, the central banks driving down interest rate, that is unlikely to drive banks to lend the way it used to. It's unlikely to boost the economy the way it has happened in the past. So I think, it is difficult time. I think it is important for investors to really embrace risk, even if they have not experienced. And we need a lot of advisors, lot of people who need to do their handholding. Because the biggest risk is not, there are two other risks. One is that even if a depositor is able to make a deposit and generate return, earn interest, which is good enough to support his income requirement. But the problem is 5 years from now, 7 years from now, 10 years from now, his capital will remain constant. So there are two needs of any depositor who depends on his lifetime savings for his income.
Yeah.
The capital should also increase over and above the return that it is generating. Otherwise, he will run the risk of outliving his savings. That cannot be had without equity. And historically, last 20, 30, 40 years, people who are retired or about to retire, they haven't experienced equity in a manner that could inspire confidence. But they don't have any choice. They have to embrace risk or bear the risk of outliving their savings.
Let me come in with a follow-up on the equity question. Now, mutual funds have been the sort of gateway or the entryway for the uninitiated into equity. They haven't really come back with great returns over the last couple of years, I would say, and you and I have spoken about this earlier as well. So where do people go right now? If the experience with banks that didn't have sovereign guarantee has been so bitter, now at least there's a 5 lakh rupees insurance for your deposits. If that has been so bitter, one wouldn't blame people for being wary. What do they do then?
Undoubtedly, they can't really be blamed for anything because this is the environmental. This is the environment. The real issue is, I would say that if not investing in equity, you don't have a chance. You don't even have hope. Hope is not a great strategy. But if you don't invest in equity, you don't even have that. But I would say that there is a great hope. If we are betting on the general, it's investing in equity is a general bet on economy that will be better off sometime in future. Last 4 or 5 years, in fact, it is so nascent. The whole investing culture in equity of a desirable kind has just been in existence for last 4 or 5 years. Prior to that, people used to invest in NFO, or people only used to get attracted to markets, into investing in mutual fund, investing in IPOs, only in good times. Remember the infrastructure fund boom or the technology fund boom. Only in the last 4 or 5 years, the SIP, Mutual Fund Sahi Hai campaign. And I find that, this crop of new investors who are getting used to, yes, last 4 or 5 years has not been very inspiring. But if you are in the positive territory, investors' behavior is dramatically, is very different when your 10 rupee becomes 980. And it's not that hostile when that 10 rupee becomes 12, that may not translate into great return. So I think, the story is, that 5, 7%, 8%, 9% return on equity over the last 4 or 5 years, which is nothing great, but still much better. And it has all the hope. I think, the method for these people in terms of, for senior citizens in particular, investing in equity in a staggered way, in a limited way, 1/3 of their money, maybe, or if they have 50 lakh or 30 lakh or whatever, on just a third, that too in a staggered way, that too in conservative fund, proven fund, direct plan, because every rupee matters here now. So doing these are the only way out. Otherwise, once you give up on hope even, because fixed income is not going to get you anywhere. And if we have interest rate coming down further, I think people will.
Let me speak to Lakshmi Iyer on that. Lakshmi? Yes.
So, Tamanna, I think...
Lakshmi, fixed income is not going to get you anywhere?
He was talking about relative. He was not talking about absolute. Absolute are going places, no doubt about it. But the fact remains that fixed income is like human water, right? And the Red Bull or the kicker comes in from equities. There is no doubt about it. You might get kicked on the wrong side at times. That's a different thing. But I think that's again part of a particular economic cycle. But there is no doubt that one needs to have coexisting portfolios comprising fixed income equities and, of course, the golden touch of gold. So that has to coexist in the portfolio. One cannot be completely lopsided to any asset class, irrespective of what returns they have to offer. And we've seen this time and again in the past. If you see, you made a statement, Tamanna, last couple of years, equities have not been good. But if you look at the last couple of years, fixed income is kind of skyrocketed. But the question which one needs to ask is equities meant for 2 years? Is equity meant for 1 year? The answer is no. But yes, fixed income does offer solutions for 1 day, 1 year, or 10 years. It offers solutions across the investment bucket. So I think it's a relative trade-off depending on your risk appetite and, of course, depending on the goals that you have. You need to plan your entire investment basket and clearly refrain from short-termism and, most importantly, the recency bias.
Saugata, let me come to you on the direction. Now, everyone has said that this is here to stay. Lower interest rates are here to stay. I'm going to go a step further. Are the golden days of double-digit interest rate returns on long-term fixed deposits a thing of the past? Is that history?
I mean, that had already been happening. I think to begin with, to preface, I think the good news in this bleak environment is that interest rates are pretty much at the bottom now. I mean, it's not going to go down any further. Not just from a depositor's point of view, from a bank's point of view, from a capital markets point of view, foreign capital point of view, everything. I think we are now the effective lower bound of our interest rates, India's interest rate. So that's the silver lining in this. It's not going to become any worse from here, from a depositor's point of view. But other than that, over a period of time, and this was precisely the intent of the inflation targeting framework, because India's costs of capital, remember, from a deposit side, you have to balance that with an investor side, with a corporate side, or whatever. I mean, so the impact of the inflation targeting environment has been precisely to bring down inflation rates and thereby interest rates to try to reduce the cost of capital for investment, capex, for other entrepreneurial activities in the country. But given this, so that was the intended target. But obviously, there has to be a balance between a deposit-centric financial system and the need to bring down the overall cost of investment, capital, etc. in the country. I think the balance has shifted a little bit more adversely without a concomitant impact on lending rates. That's the problem. I think the spreads between the deposits that we are getting and the lending rates for a large segment of potential ratings, rated companies, I think that's the problem. And I think that's where the focus needs to shift. I think a little bit of an increase in interest rates, but the focus on reducing the costs of the spreads for multiple companies with various government-supported programs, RBI programs. I mean, I'm not going to get into that. But that, I think, is the potential way out from a more macro point of view, from this relatively bleak environment on low interest rates that we are going to see at some point, for some time. That's going to persist for some time.
Dhirendra, I just want you to, sort of leave this discussion with your advice. You talked about staggered investments for senior citizens, etc. But what about those who have limited funds, who have a meager corpus and want to invest, want to do something with their money instead of it lying around in a savings account, but don't have the risk appetite at all? Should they be looking at bonds, maybe RBI-backed bonds? Should they be looking at some investments in NBFC-backed deposits, etc.? Or should there now be some real thought about something to reach out to this section of savers?
No, there is a very clear hierarchy in my mind that, any depositor, any risk-averse person who requires income from his investment, how he should go about it. I think, if you're a senior citizen looking at, that first step, go for that senior citizen savings scheme. It gets you the highest return at all times, relatively. There also the return has come down, but it gets you the highest return with the highest safety. The problem is that you can invest a maximum of 15 lakh there. Follow it up with, the post office MIP. There also there is a limit, and then work towards optimizing your return, because the need for guaranteed income in your retirement to derive income from your investment is paramount, and that is also the stage when you panic a little upside. So equity cannot be at first stop. As I was telling you that, for a person who has never invested in market-linked investment, people are having a hard time settling with, investing in a fixed income fund and seeing the ups and downs. In fact, that where the returns can get optimized, it can be marginally better. But, it requires a lot of hand-holding, guiding him to one of the 16 kind of fixed income funds available to them, and which one is appropriate at what time, what to expect, setting their expectations. So, it requires a lot of, it's complex for him. The people who have been used to the simplicity of working hard, earning a salary, and, parking his money, let it lie somewhere, and the job used to get done. I think investing in equity is important for, and is possible only for that person who goes beyond this level, because equity cannot be invested for an old person at one go. So stagger it and make sure, and the only rule that you have is it should be a certain allocation. Maybe to begin with 20% of your total money, if you have this, if you are able, your 80% is able to support your income, and then spread it over the next 18 months, 24 months, because the real problem is not that the equity is volatile. The problem is that you experience the volatility the moment you invest lump sum. Spreading it over time, and meanwhile, and making sure that most person at that stage. So the time frame of investment, spreading your investment, which fund to choose, not the conservative fund, because what has happened is that people have got a very bossed up experience. Last 2-3 years, a lot of investors invested and the small cap fund. Now that is going to be, that's a wild ride, that is meant for a person who has 10 years of time and really never loses his sleep if he sees 20% decline in value of investment in a month. An old person cannot really absorb that.
Absolutely. I think one key takeaway from what Dhirendra is saying is that it's no longer just, put your money away and stop thinking about it. It'll work for you. Thodi mehnat lagegi. You will have to make the effort to make sure that your money is working for you in an environment which is not very positive, would I say hostile for just simple deposit savers. Well, we hope you found this useful, and thank you so much to all of you for joining us on the show this evening.
Thank you.